Today's financial advice is sponsored by Endeavor Private Wealth. Good morning, everybody. Chris McGee here is joining me, managing partner at Endeavor Private Wealth. And it's our weekly segment on investing. Now, good morning.
Good morning.
So how are you doing today?
Excellent. Thanks for having me.
Well, thank you. Well, Chris, the recent news about the economy and the markets has been pretty up and down for the past few months, and a lot of consumers and investors are on edge. What are your thoughts on the current state of affairs?
Yes, Dane, thanks for having me. And up and down is a good way of describing the financial markets. You could also say presently and persistently.
So you say presently and persistently, like what does that mean?
So presently, because last week the Bureau of Labor Statistics released their report on inflation, and it showed that inflation was at a 4-decade high of 8.5% through the end of March. Now, this is explained by the red bar on the graph, and then next to it is the blue bar, which is food prices, which have risen a similar amount. And then next to that is the black bar, which is energy prices, which has skyrocketed over the last year. Then finally, that green bar is basically the core price index, which is those inflation items minus energy and food prices, which that's the one that gets all the attention. But to me, it's a little silly because, you know, why would you leave out food and fuel costs and heating and cooling your house? But anyways, that's the one that gets the attention. And so whichever data points you want to follow, they're all going up an awful lot lately. And that's what's causing the Federal Reserve to want to begin the process on rising interest rates and the process on quantitative tightening to help rein in inflation.
So what does this mean for the stock market?
Well, typically inflation is not very friendly to stocks or bonds. And I brought another graph to help show this, courtesy of JP Morgan's Asset Management Group. And on this chart, it shows the black bars, which is the average returns, and then those red dots below are the intra-market year lows that it has gotten. So the black bars are basically the S&P's return, and the red dots being the lows. On average, or if we go through this year, we're actually down about 9% or 8% on the S&P 500, and the intra-low dot has been down as much as 13%. Now, whether we're going to finish higher or lower for the year, nobody has an accurate crystal ball. But on average, that chart shows us that the intra-year low is about 14%, so we're kind of in that area. And then the market has also finished positive 32 out of the last 42 years, and that equals basically an average return of 9.4% on an annualized basis.
So really, ups and downs are just a part of investing.
They are a part of investing, and that's where whether we all want the ups, but we know that if there's going to be some gain, we may have to take some pain with that. So whether we're training for a 5K or a marathon or saving for our kids' education or a long-term retirement plan, it really comes down to having a plan in place, having a trusted coach or a financial advisor, and then sticking with that plan and having the discipline to stay with it, even during the difficult and tough times. And that will help increase your odds of achieving your financial goals.
All right. Well, thank you so much, Chris, for everything you just said. For more information about dealing with the ups and downs of investing, check out Endeavor Private Wealth at endeavorpw.com.